Just a quick introduction on Valor. It's the easiest way to think about what we do is I'm sure most of you have heard stories about how billionaires, ultra high net worth people avoid taxes. There's always stories in ProPublica and New York Times about this. Now, these usually stories talk about how they avoid taxes, and then it goes from how much they avoided to kind of this end result about issues in the tax code or things that are not digestible. What we do at Valor is we essentially take those same structures and opportunities these billionaires, ultra high net worth people do. We use technology to automate it, build education, and make it accessible to everyone. That's kind of the key thing. And we're really kind of the thesis is if anyone is taking advantage of these opportunities, everyone should be able to. And we particularly, we were founded last year and are very focused on kind of the startup ecosystem and crypto ecosystem. But we do serve other use cases like real estate, SMBs. And just for kind of where we are as a company and what we've done. So we're backed by Box Group, Canaan, Basis, number of other venture firms and angels. Since we were founded last year, we've helped create more than $500 million in kind of after-tax wealth from tax savings for our customers. So that's kind of who we are, what we do. And as we're going through this presentation, we're going to, as David mentioned, we're going to walk through kind of like why you should care about tax planning. What are some of the specific things that you should be thinking about and things that folks in your position often overlook that we see? And then what are some of those opportunities and high level of what you should be thinking about, what you should look into. And then we're also going to share some resources that we've built that we often find people in your situation find helpful, and share some kind of follow-up materials and contact information if you have questions. So, and feel free to add questions to the chat box if you have questions as the stuff is going on. Now, just to caveat this is tax things aren't simple. The government doesn't make it accessible, and it's not built to be accessible. So there's going to be things that come up that you may not understand. Don't feel stupid to ask any questions. Fortunately, the system isn't built to make it easy for you. So that's also on the opposite side. That's the opportunity. Now, I'm going to share my screen. There we go. Okay. Hopefully everyone can see this. So again, here's kind of key things we talk about: basics of tax planning, why you should care, how is equity taxed, some opportunities, and how it can help. So this is, most people probably know about compounding, but this is the kind of fundamentals. I don't want to skip over this because this is why tax planning matters. If you don't understand compound interest, you're not going to understand why tax planning matters. Kind of the key thing is every additional tax savings and tax reduction or tax deferral you can make up front can have huge tax implications on your financial situation and how much money you're able to save. It is the difference between, this over the course of 20 years, you can create an additional 74% wealth just from tax deferral in the situation. And a lot of these tax strategies, some which we'll talk about today, some which we aren't, can create significantly more returns over this time frame than this example. Really, all you should take away is tax planning is very important. If you're going to have some of these exits, you should be thinking about these things. So, and the simple kind of idea behind compound interest is that additional returns, because the growth keeps on growing on itself. So this is the kind of simplest example is if your assets go 10% a year and you start with $100, in year one, it's $10. In year two, it's $11 instead of $10, because the growth keeps on, the bigger your assets, it grows faster and faster. It's really these things that you do up front and now make a significant difference towards your future quality of life. Now, tax planning. Most folks, when they hear about taxes, it seems just inaccessible and they have no clue what it is. It's all these things like buy, borrow, die, offshore accounts, partnerships, insurance. Some of you have heard about the Teal IRA. Now, all those things sound complicated and they are tax planning opportunities. The reality of tax planning, it's just the use of legal methods so you can lower how much you pay in taxes. Pretty simple. All of you actually take advantage of, or most of you are taking advantage of tax planning today. Think about just using an IRA or an HSA. All of these things are trusts that are tax advantage and are simple examples of tax planning. Even things like just setting up a revocable trust. That is tax planning, estate planning. So don't feel like it's inaccessible and something that you guys is outside of your grasp and you shouldn't be thinking about. you're already using it. And what we want to call out is some of those easy opportunities that you should be looking at and are particularly relevant to folks in this ecosystem. So let's, before we get too deep, here's some of the most common things that we found, and this is kind of inspired by David here, that folks often, some mistakes and things that people overlook in the startup ecosystem. So just to start with, I don't know how many of you know about QSBS. If you're angel investors, founders, or employees in startups, this is one of the top things all of you should look at if you live in the United States. This is the best tax break around, and particularly is really applicable to folks in the startup ecosystem, particularly folks involved in the early stage ecosystem. We're going to dive deeper into it later in this presentation, but just want to call this out of, if you are involved in this ecosystem and aren't aware, pay attention to this. And I'd say we'll send over some articles later. I'd say it's definitely worth reading about that. The other second piece is understanding if you can early exercise. This is probably most relevant to founders and employees. If you can early exercise and the tax implications of it. Options are very complicated, unfortunately, from a tax standpoint, with things like AMT, ordinary income, capital gains taxes. Most people aren't necessarily aware of the implications with their options from early exercise to these tax things. And spending some time to understand that, particularly if you join early, has huge financial implications to the opportunities later in life. As an example, spoke with someone from Instacart today, who they were an early Instacart employee. They had the opportunity to early exercise, didn't think about it till now. And the net difference is it's expecting to create $5 to $10 million of lost wealth because they didn't think about these things and are only looking at it now. So again, something we can share resources on, but really important if you are early to look at and understand these things because of the impact it will have. And the third biggest thing to call out is understanding what are your financial goals and how does it tie to this equity? Are you trying to maximize the assets? It's really tax versus estate planning. When do you need the money? So are you trying to use it? Are you trying to pass it on to your kids or future generations? And when do you need the money? So just being able to have some level of thought of what you're maximizing for helps kind of identify what solutions make sense and what opportunities are there and what you should be focused on. Just checking. Okay, no questions so far. So why do you care about tax planning? Let's take a real example of an angel investor we worked with. They were it's a New York City resident, so probably very similar tax situation to, there's a lot of Californians here. They're planning to sell $1.5 million of angel investments, or an angel investment that's worth $1.5 million. They would owe about $500K in federal and state local taxes without tax mitigation. Now, with tax planning, they were able to create an additional $2.5 million of assets for themselves. And this is why you should care, right? It's more than a 40% return through pretty simple structures, but things that they'd otherwise be aware of. And unfortunately, most people aren't aware of. And we'll go into deeper kind of what structure they use and some of those things, but this is really, with appreciated assets, there's huge upside to thinking about these things, and it's even more important to do it. But most folks, it's not accessible unless you have a family office historically, and that's why most folks miss out on this stuff. So now let's just kind of the basics of what are taxes driven by and what is tax planning. Really, for most folks, taxes are driven by the difference between what the price you invest in and what you sell it at. So hopefully that's nothing new to most folks. The other big piece is the tax rate that you pay on that spread. So those are kind of the key things that there are, and that leads to a couple of different opportunities. Now, this applies to founders, employees, investors. So fundamentally, what's the difference between what you buy it at and what you sell it at, and what is the tax rate? And all of those things can be manipulated in different ways, which we'll dive deeper into. So at a simple level, tax planning is what you get from a sale is the company's exit, your ownership equals your payout. But ultimately, that's not what you take on. Everyone here knows, unfortunately, your cost is in part dictated by taxes. And that's what tax planning is how do you fundamentally lower your costs so you can keep more as a takeaway. Now, what can you do here? There's kind of three things to the earlier thing that you can control. The number one is how can you maximize tax exempt assets? So completely avoid taxes, or for the most part, avoid it. This is where QSBS is one of the tax breaks around. Candidly, it's not something we can share materials. It's not something you need Valor for, or really you don't need much to pay anyone to take advantage of it, but you should all be highly aware. There's no better kind of tax break than something where you can completely avoid taxes. Second big piece is how you can turn ordinary income or short-term capital gains into long-term capital gains, because that significantly lowers your tax rate. In some cases, it may lower it by half. Now, in many cases, that's the difference between early exercising or waiting between when you own a shares, waiting at least a year to sell. Some cases that you may or may not be able to control it, but it's something you should be aware of. The third big piece is tax advantage structures that you can take advantage of when you are going to sell and realize income. Most of you are aware of IRAs, which are retirement accounts. You may have heard of the Teal IRA, but other really powerful tax advantage structures are CRTs, also known as Charitable Remainder Trusts, and opportunity zones, which we'll dive deeper into. Those are kind of ones that typically as you get into a family office environment, more people start to take advantage of. But without that, unfortunately, most people miss out on. Now, let's kind of dive into some of these opportunities here. So QSBS, so this stands for the Qualified Small Business Stock Exemption. This is something, the intent behind this is the government wants to encourage people to invest, start, and join small businesses, because that's the job growth and economic engine of the US. So the government has given really powerful tax breaks to people who do that. And what they do at the federal level is they give you, if you meet certain requirements, so such as the company is a US-based C corporation, it's in specific industries, tech typically qualifies, and you've owned your shares for 5 years, and you received your shares when the company had less than 50 million in net assets, you can avoid taxes on your first $10 million or more of gains, which, sounds like a lot of you are Californians, you'd otherwise expect to pay, close to 35%. Obviously, that's a huge difference. And so that applies to federal taxes. In addition, 46 out of 50 states also follow QSBS, and so you can avoid state taxes. Now, unfortunately for you Californians, California is one of those 4 states where you don't get that tax break. Probably not surprising for you folks, is you don't expect many tax breaks in California. So that's kind of a key thing to call out. And this typically applies to angel investors, and founders, and early employees. It is, if you are eligible, if you join early stage or invest in early stage companies, you should really understand this, because it's the best tax break around. If your shares are eligible, and thinking about how you can take advantage of it is really critical. One of the 4 sophisticated LPs in early stage funds, one of the key things, the reasons that they allocate to early stage funds is QSBS, because of the impact it has on their return profile. So it's one of those things of, if you're not thinking about, but you invest in the space, I'd say the number one takeaway from this presentation is you should read and understand this. Second structure is kind of an opportunity zone. So the opportunity zone, it's candidly a very new investment structure. It's created in 2017. We haven't seen full vintages. It was created to encourage people to invest in distressed real estate areas. So the government essentially allowed you to defer. If you sell an appreciated asset, it allows you to roll over those proceeds to an opportunity zone and defer those taxes until 2026 if you invest in this opportunity zone. Candidly, as each year passes on, it gets less lucrative because we get closer to 2026. The other big risk, there's a couple big risks, is all your assets are reinvested in a small number of real estate projects in one sector. And we haven't seen a full vintage because it was just started in 2017. IRAs. So most of you are probably aware of IRAs or take advantage or utilize them. IRA stands for Individual Retirement Accounts. It is an irrevocable trust that the government specifically created to encourage people to save for their retirement, with tax breaks around. So standard IRAs allow your assets to grow are a tax exempt structure where every time you sell assets in the structure, you don't pay taxes. So let's just say a simple example of, let's say you had an angel investment cost basis is close to $0, and you're a Californian who sells it for $1 million. If you sell it in a non-IRA account, you would pay roughly at 35% taxes. And so you'd pay $350,000 in taxes and keep $650,000. However, instead of that angel investment was made from an IRA, it would be tax exempt, and the IRA would keep $1 million and be able to invest $1 million. I'm going to assume all of you are smart enough to understand of whatever your expected growth rate on assets is, 5%, 10%. North of that, $1 million at that growth rate versus $650,000 is going to do significantly better. Now, downside of IRAs is you can only contribute between $5,000 to $8,000 a year for most situations. And outside of certain kind of emergencies or like health emergencies or education, you have to wait till you're 59 and a half to withdraw from it. Now, charitable remainder trusts, this is candidly what we see the most kind of founders, angel investors, and operators take advantage of. Is it's very similar to an IRA, and it's a tax exempt structure that, so in the same scenario, if instead of selling the asset and keeping $650,000 and paying $350,000, if you sell that $1 million of assets into a charitable remainder trust, it's tax exempt, you keep the $1 million and can reinvest it. The reason we see this as kind of more popular than an IRA is you don't have to invest from the IRA. So you can invest in your personal name, transfer the assets to a charitable remainder trust, and you're entitled to distributions every year if you want. So you don't have to wait till you're 59 and a half. So it's a lot more flexible, but also carries those that tax exempt benefit. So that's those are kind of some key things. Say it's definitely worth reading about if you're not aware of, and better understanding if you're in the space, because again, the reality of the startup ecosystem is you're going to have highly appreciated assets when you have these big wins, which create a lot of tax liability. And the difference of taking advantage of these tax planning opportunities isn't minor. It's fairly typical for the net difference to be more than 50% of your exit. So think about what that means. And for many folks, it's life-changing in terms of kind of financial safety, security, and their quality of life. Now, QSBS, this is the deep dive, started in 1993. Key things for people to be aware of is the eligibility. You have to receive the shares directly issued from the company. So what that means is you have to buy it from the company or receive it as an employee. The one exemption to that is if someone who directly received it from the company gifts it to you. So what that means is, I'm going to pick on David here. So David has on-deck shares. If David sold me on-deck shares, I am not eligible for QSBS. However, if David gifted those shares to me, then I might be, if his shares are QSBS eligible, my shares would be QSBS eligible. Second piece is, from the date you own the shares, so whether you invest or exercise, you have to hold it for 5 years. Third piece, it has to be a domestic C corporation, and which for most folks is fairly standard. The other kind of two pieces are, it has to be in specific industries. Most tech companies qualify, so that isn't an issue. The small business requirement is it has to have less than 50 million in assets. A rough heuristic is if it's raised 50 million, but that's not an exact thing. The easiest way to find this out is to ask your company, whether it's a finance or someone, if your shares are eligible for QSBS, and they can definitively tell that to you. Now, again, you can avoid taxes on the first 10 million of gains, but in addition, there are tax structures where if you have 20 million or north of 10 million, you can take advantage of QSBS you can get multiple QSBS exemptions and avoid those taxes. Seeing two questions tied to this. So an SPV like Angel is, so each person in an SPV should have their own QSBS exemption if at the time you invested it is eligible. So assuming it's eligible and there's 20 people that are invested, they each would have their own $10 million exemption. Just as a kind of a context on this, for QSBS, there's $10 million exemption per individual per asset. So if you invested 3 times in a company, you don't get $30 million because it's per asset. Now, the nuance of this, and some of you may have heard this, and there's different feelings on this, of corporations and trusts, according to U.S. legal, according to U.S. laws, are individuals. They get their own tax exemptions. And this is how folks, if they have more than $10 million, they'll often gift their shares to family members so they can claim their own exemption because they're another individual. Or if they still want their own control, they will set up a trust that has its own tax ID, but they can benefit from, gift the shares to a trust, and that trust can claim its own exemption because specific types of trusts are their own individuals under a US tax code. So that's how, in a situation where you have more than $10 million, you can claim multiple exemptions. There's a question here, is it $50 million on the grant or $50 million on the exercise? It's a great question. So the company should have less than 50 million in net assets when the shares are granted. But the 5-year rule starts from when you exercise. So it's 2 different timings there. The shares qualify based on when you were issued the shares on the net assets piece, but then the applicability on the holding period is from when you own / from that period of exercise. If you angel invest via an LLC, you should still qualify. There's nuances because there's different ways you can invest, but in most cases, use an SPV, things like that, each individual gets their own exemption. This is a good point from Ollie. It's on the conversion, not on the safe date. So when the company, when your shares, again, when you invest in a safe, you don't actually own the shares until they convert. So that's a good call out there. You don't have to gift the shares when you start the company. You can do it later. Now, there are nuances from like a estate planning of when you want to move those assets out of your own estate that comes into play. But to claim QSBS, it has to just be when the shares are sold, that it's owned by a different entity. So we'll dive into gifting the shares. It's typically kind of an estate event based on your gifting. Not to get too deep on this, but in the US, there's what's called the estate tax, and you have a lifetime gift exemption where you can gift a certain amount of assets before you start to pay taxes on that. So annually, you can give $15,000 per individual every year. And over your life, you can gift $12 million before you start to face an estate tax. So you're not going to face an income tax for gifting assets to someone until you cross that $15,000. But that when you gift over $15,000, that counts towards your estate tax. So the answer is yes and no, depending on what you're looking at. Now, charitable remainder trust and IRAs. So to just kind of recap what we talked about earlier, both of these are tax exempt structures. So they're really powerful for highly appreciated assets. And the reason, so that the more appreciated your asset is and the higher your tax rate, so i.e. for you Californians, New Yorkers, East Coasters, the more valuable these are. Again, simple reason of if you have a zero cost basis asset, the lower your basis and the higher the asset's worth, that delta is taxable. So the more the appreciation, the more that can be taxed. The higher your tax rate, the more that you're going to lose to the government. So utilizing tax exempt structures like IRAs and charitable remainder trust is really powerful to help you defer, to essentially reduce the impact of these taxes by deferring when you pay them and being able to reinvest that money and keep more for yourself. Now, the trade-offs between IRAs and charitable remainder trusts is they're both tax advantage where you can get initial tax deduction and capital gains are deferred. Big difference for most folks is with the traditional IRA, you can only contribute between $5,000 to $8,000 per year. While with the charitable remainder trust, you can contribute unlimited amount of assets. So you can contribute, we have customers who've contributed $70 million of assets in a year. So you see a huge kind of range and it gives you a lot of flexibility. Most of the folks we see in kind of the tech ecosystem, they're going to invest in assets on their own balance sheet. And then before they sell it, they'll move it into a charitable remainder trust to sell it in a tax exempt environment. And the big advantage relative to an IRA here is they preserve the flexibility to wait to move it into a charitable remainder trust until the last minute versus having to invest upfront from their IRA, which is capped and typically has less funds. The other big piece is distributions. It's an IRA. Again, it's built to manage for your retirement, so you can't withdraw till you're about 60. If you do, you'll face penalties before then. versus with charitable remainder trust, you're entitled to annual distributions. So there's a lot more flexibility. Now let's jump into kind of this example mentioned before about this New York City angel investor. They use a charitable remainder trust, and this was they made a small investment that had done phenomenally well. They're selling it for $1.5 million. They were going to pay about 35% tax rate, so about $500,000 in federal, state, and local taxes. So they would have kept $1 million after this, versus they used the charitable remainder trust. So when they put the assets into the charitable remainder trust, they got a $150,000 charitable deduction that reduced their taxes this year, so saved them some money up front. But the biggest thing is when they sold their stock inside the charitable remainder trust, there's 0 taxes paid up front. So they kept that $1.5 million into the trust that could reinvest and create more wealth for them, because just $1.5 million versus $1 million is going to grow a lot faster. Now, the way that these distributions are taxed is when you withdraw money out of a charitable remainder trust, similar to an IRA, that's when you pay the taxes. So it's not a tax avoidance. So it's not completely avoiding it, but it's deferring it. You can think of it like a 0% interest loan from the government of you don't pay it up front, but you're able to, when you reinvest that money, when you do withdraw it, you are able to, then you pay the taxes. Now, 2 questions came up here. How much goes to charity? The IRS is estimating that about 10% of the proceeds of what you put into a charitable remainder trust will go to a charitable cause. And this is why they give you a 10% charitable deduction. So in this example, you're putting in $1.5 million of assets, and you get a $150,000 upfront charitable deduction. That's because the IRS is estimating that at the end of the charitable remainder trust, you'll leave net present value, so that today's value of $150,000 in the charitable trust, maybe more or less depending on growth rates when you withdraw various scenarios, but that's kind of the IRS's estimate, and they zero it out by giving you an upfront charitable deduction. Now, with a charitable remainder trust, you don't have access to all of the proceeds up front. Every year, you're entitled to a percentage of the trust's value. So how much that is depends on how long you set the trust up for. I'm not going to go too deep right now. For most folks, it's somewhere between 6 to 11% annually that they can withdraw from the trust. So you are giving up some liquidity up front, but typically the returns are more than worth it if you don't need all the money up front. Scenarios where this we've had a number of customers where, they want to buy their first home or things like that. If you need your liquidity, if you need to spend the money now, you're not, there's less tax planning opportunities that are available to you other than things like QSBS. Now, generally, one of these things that everyone here knows is there's generally no free lunches. So with tax planning, you're usually giving up something, whether it's liquidity or something else. There is a trade-off. And in this case, you don't have all the money up front, but you're able to defer and reinvest the taxes as the trade-off. So on the founders piece, so founders can put their own equity into a CRUT. The way to think about that, first of all, this is where if you're a founder, if you're going to, before you sell, if it's going to be 5 years, take advantage of QSBS. Take that first $10 million, give those shares to kids or kind of other family members so they can claim their own exemption. And beyond that, that's where, or if your shares aren't eligible for QSBS, this is where CRUTs come into play. One of the big advantages is you can contribute assets at any time. So you don't have to put the assets in today right after you start the company. You can wait till you start to have discussions to sell your company. Until you agree to sell the company, you can put the shares in and take advantage of the tax exempt structure. Now, one additional kind of nuance, I mentioned this before, is some types of trusts get their own QSBS exemption. CRUTs are one of those types of trusts. So let's say you claim your own $10 million exemption, but you have an additional 10 million in shares that is QSBS eligible. If you give those to a CRUT, they can claim their own exemption. And when those assets from the CRUT get distributed to you, you'll be able to avoid the taxes and claim and take advantage of that QSBS. So that is kind of one of the ways that it's used and can be taken advantage of. Now, just as a follow-up, this is obviously a bit complicated. We're going through some of the high-level benefits and things to take advantage. We can send over some resources, and we'll include some in this presentation on calculators so you can see the ROI of using a CRUT for your situation, as well as some reading materials on it to just deep dive. We've created a lot of stuff around this, and we're also happy to jump on calls if it's helpful. Can you put a GP stake into a CRUT? Yes, you can. So you can put real estate GP stakes. We have everything from people putting SMB, their small business into these things. So that's very common. You can't put LP stakes into, or sorry, not L. You can put LP. Sorry, you can't put carry into a charitable remainder trust. So you can't put active business interest that you're operating. For instance, you can't assign your salary to a charitable remainder trust. You can put passive investments into these things, which is why real estate, stocks, crypto. If your LP stake you can put into this, you can't put your carry though. Now, this is kind of just to deep dive on, and this goes to Ollie's question of how much goes to charity. So in this example, 1 million with $1.5 million exit, without the charitable remainder trust, you'd keep $1 million. And this is kind of where the net difference comes from. So with that $1.5 million, and again, compounding, which we kind of initially talked about, with the trust is going to net have an additional $3.7 million. Now, you're going to, over the course of your life, estimate keep an additional $2.7 million, because $1 million is what's that charitable donation that goes to them. So this is the easiest way to think about this is you win, a charitable cause wins, and essentially, if you want to see that there's a loser, it is the government in this case. But this is something they understand, and they believe in, kind of the same reason they give charitable deductions for charitable donations. They believe that trade-off is worth it and have built it into the tax code. So that's kind of where the money comes from and how it's allocated. Now, just as a quick, going to leave some time for questions and just kind of an overview of Valor. So what we do is we try to make it easy for everyone to take advantage of these same kind of tax structures and estate structures that, the Phil Knights, the Mark Zuckerbergs of the world take advantage of. So we do is we built a lot of education, content, calculators, and we're also happy to jump on the phone to help you figure out what are the right tax structures and opportunities for you. Kind of the biggest piece that we do is we've automated the setup and administration of these structures, which is why, so typically if you're going to pay a lawyer, you'll probably pay somewhere between $10,000 to $25,000 to set these up. We charge no cost. And kind of the third piece is, and this ties to technology, we also have automated the administration of these structures. So versus paying a Charles Schwab or JP Morgan, we're less than half the costs of them to administer and take advantage of these things. So our whole thing is how can we use technology to make these more accessible, from helping people understand to also take advantage of them so that everyone can build wealth more efficiently. That's kind of who we are, what we do. We'll share this presentation with you, but we're always happy to jump on the phone to connect. We also have calculators and learning materials online so you can understand these things, play with it, see what different structures make sense. There's a number of, going to something I mentioned earlier, the structure that makes sense for you really depends on who you're solving for to utilize the assets. Is it for use during your lifetime? Do you want to pass the assets on to your kids? Or do you want to pass it on to multiple generations from now? And then the type of asset, are you trying to write off ordinary income? Are you trying to sell an appreciated asset? Depending on what your goal is and what the asset is, there's different structures for them. So we have materials online that we can share with that. So the QSBS is $10 million per individual per asset. So it's not that the year piece doesn't come into play. For instance, let's say Q Angel invested in 2 companies or had founded 2 companies that happen to exit in the same year. You could claim $20 million of exemptions in your own name, 10 million from each asset. So it's not per year, it's per individual per asset. Now, how does stacking, so the QSBS beyond $10 million, it's called QSBS stacking. We can share materials on this to read through. If you want to just search on Google, it's called QSBS stacking. And what that really means is stacking those $10 million exemptions on top of each other. And this really ties to, again, you can claim $10 million per individual per asset. So if you have more than $10 million per asset, you're trying to maximize the number of what are considered individuals who can claim that $10 million exemption. And this is where on the tax code, Individuals can mean a different individual. For instance, Ari and David are two different people, so they get their own exemption. But in addition, from a tax code standpoint, particular types of trusts are equivalent to Ari or David as different individuals. So you can set up, for instance, a charitable remainder trust. There's things called INGs, incomplete non-grantor trusts. There's different structures that get their own exemption. So if you want, let's say you have $30 million in a startup that's QSBS eligible. You claim $10 million. You could then put $10 million into charitable remainder trust. It'll claim that exemption. And then maybe you give $10 million to your kid or a parent, and they claim their own exemption. And so through that, each individual, and again, individual can mean a trust, a different person, gets their own $10 million exemption that they get the federal exemption on those capital gains. And if they live in one of the 46 out of 50 states, they can claim the state exemption as well. So for documentation you do need to claim upon QSBS. It's an interesting question. So QSBS there's not actually much documentation needed to claim for QSBS, which is kind of an interesting twist. QSBS is one of the more poorly defined sections in the tax code. So you don't actually need much. Most people tend to send it with they'll want a letter from the company stating that they are eligible for QSBS, which is that they meet those 5 requirements that we outlined before. They'll share those details showing kind of when they exited, when they exercised or owned the shares, what they exited for, and showing how it kind of fits within that. But you can add more or less. It's kind of just an interesting nuance that there aren't actually many requirements. There is a particular way to file your taxes that year and document forms that you need to attach. That's something, so this is for most folks who do this. This is one of those situations we recommend having a tax accountant just help you fill out those forms and file it that year. But you can do it yourself. There isn't actually that much overhead. Most seed or Series A investments, or if you join that company, would qualify. Historically, that's true. There's some situations that it's in the wrong industry, it may not. So for instance, like if it's an agriculture business, but again, most of you folks won't be in that, like that may not qualify. I'm not sure if the QSBS, if pieces of the assets are sold in a few years, you can apply QSBS multiple times by yourself to the same asset, as long as it doesn't exceed $10 million. So let's take a situation where someone sells in a secondary, they sell $4 million, and then there's an IPO and they're selling $8 million. They can claim QSBS individually on the first $4 million in the secondary. Then on the $8 million on the IPO, they could claim an additional $6 million a couple of years later on that, because that gets them to the $10 million per asset. That next $2 million, they'd either have to put in another gift to someone else, another individual, or pay the taxes on it. So it sounds like there's a lot of interest kind of on QSBS and the kind of the charitable trust piece. So we can, as part of this, share some resources. We'll share this presentation with David and the team, and they can share it with all of you and share some of those resources on QSBS stacking, as well as charitable remainder trusts, if you're interested in learning more. And we're also, if you want to jump on a call, if you have an applicable situation, we're happy to do that as well.
Yeah, I think Jeff shared a link in chat if people want to chat with the Valor team, but also this presentation, as well as the additional resources that, Manny can send me about, like QSBS, Charitable Remainder Trust. We can include that in recording on the directory. So you can find that 24, 48 hours after the session as well. I think we have a couple more questions over here. Katsuya has a question as well. Like, when would be the best time for founders, employees to engage with Valor, founding, exercising, sales? Like, what do you think so?
Yeah, so I'd say that it's a great question. And this goes to, one of the high level, and I'll take a little step back, depends on the problem you're solving for. So I'll lay this out. So there's tax planning, estate planning, and dynasty planning. So tax planning is if you want to maximize the assets you can use during your lifetime. So this is if you plan to spend the money, you, your spouse, plan to use it during your lifetime. Estate planning is if you want to maximize the assets you'll pass on to your kids. And this deals with how do you avoid the estate tax. So I've mentioned this before. This is where it's federally, you start to pay the estate tax if you're going to pass on more than $12 million. Now, that number is going to drop in half to 6 million in 2026. So if you're trying to maximize the assets you pass on to your kids, then you'd rather start to work on it sooner rather than later. If you're focused on tax planning, it's likely closer to a sale. So if you're planning to sell your shares, before you agree to sell your shares, your equity, your crypto, your whatever asset you're looking at, that's before you make a sale. That's when you'd want to talk to us. If you're focused on estate planning, sooner rather than later, because the more your assets appreciate, the higher estate tax you'll face when you pass those on to your kids. So you'd want to do it sooner rather than later. On the dynasty planning, so dynasty planning is, it's not if you want to pass it on to your kids, if you want to pass it on to 2+ generations from now, so multiple generations. So it's, literally thinking about dynasty. That's also one of those situations where it's better to do it sooner rather than later, because as your assets grow, you actually face higher taxes. So it's better to pass those assets on now and let the appreciation happen after they're passed on. Now, one of the things to call out, another piece is, the key thing is to figure out which problem you're solving. So are you solving for yourself? Tax planning, estate planning for your kids, or dynasty planning for future generations, and then also different assets. For instance, I mentioned a lot about QSBS, which is really applicable to a lot of, in this case, early stage investments, or if you join an early stage company. Charitable Remainder Trust if it isn't QSBS eligible, but also different assets, for instance, carry came up. There's a different product, so it's not eligible for Charitable Remainder Trust, but there's a different product, that tax advantage product, that is eligible for, typically called a parent seated trust. So this is one of the sad parts of our tax code, is kind of a sad, or well, it's mostly a sad, but it's also a fun fact, is in the last 50 years, the US tax code has grown by about 150,000 words per year. What that means is there's a ton of tax opportunities for different assets, different goals to take advantage of. But the unfortunate reality is, it doesn't matter how smart all of you are and how hardworking, it's too complex to understand. And this is why these billionaires, and you see these stories, people with massive family offices, they're able to really aggressively lower the tax code. It's because they can throw an army of accountants and lawyers to work through the tax code and find those opportunities. And what we're doing is we're kind of taking an infrastructure as a solution approach of, for each use case. So carry, appreciated assets, we're productizing how to think about it, the calculators, the learning materials, as well as the setup and administration. So we're trying to say we're solving on a use case by use case basis. The critical thing for you to think about is, which problem are you solving for, and which assets are you trying to solve it for? Because that may lead to a different solution. The IRS does not, now unsurprisingly, the IRS doesn't have an incentive to do this, to make this simpler, because candidly, it leads to higher taxes. The more complex it's funny, there's some of this that's regulatory capture, but it's a bigger way to increase tax revenues is to make this complex so people don't claim it. And on the other side, it grows the size of the IRS. So it would be nice if they made these things simpler, but I wouldn't bet on it.
I love it. Another question that I usually get around QSBS is kind of like, what happens if an investment you make 2 years, 3 years later goes through an exit or a forced liquidity event? Like, how do you still apply the QSBS there?
Yeah, this is a good question. I think the thing that you're asking is, so there's that you have to hold it for 5 years. So let's say it was an early stage company that you joined or invested in. So it's eligible on that. It's a C Corp in the right industry, but you haven't held it for 5 years. So you can roll over QSBS eligible investments. I believe I think within 60 days. So if you exit that QSBS investment and roll it into another QSBS eligible investment, the clock keeps going. So if you've held it for 3 years, it would only need to be rolled over into another QSBS eligible investment for 2 years before you can claim QSBS. So that there is an opportunity if it exits before then. It is fairly rare to see this work for non-institutional investors, just because when you have these exits, it's usually hard to deploy that amount of capital into QSBS eligible investment that quickly. But you may be able to do it for a portion is more common.